or as I always say, it's afternoon here for us in the UK. I know some of you are joining us from the North America and from all sorts of parts of the world. But wherever you are in the world, you are very, very welcome. As always, before we start, may I just draw your attention to the disclaimer that I know you can see on the screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. Right, as we've lost a few minutes, I'll just rattle through the next literally 2 more slides. Those of you who come along regularly will know we'll be looking at the charts through the prism of volume price analysis. What is volume price analysis? Well, all the details you can find on the books that are up on Amazon, and it is essentially looking at the chart through the prism of price action and volume to try and determine whether what you're seeing on the chart is actually a valid move or not, because as you know, this is a very, very as I think I say in Australia, a very shonky business. Lots of manipulation, lots of nasty traps and tricks to make you part with your money, and we certainly don't want to do that. But once you can read the chart with price action and with volume, you will certainly have a tremendous advantage. But VPA it's more than that. We've expanded that principal concept, if you like, to include support and resistance, candles, candle patterns, and crucially time. And that's not just the time chart that excuse me, you're actually trading, but looking at what you're seeing on the chart in multiple time frames, because that also helps you to judge whether the move that may be happening, say, on a 5-minute chart, which is the chart that perhaps you like to take your trade on, are you perhaps trading a pullback? Are you trading a half decent correction of a move that is completely contra to what is happening on a slower time frame? And it's really important to be able to look at price action in multiple time frames and to actually hold in your head this sort of this paradox, if you like, that yes, we may be seeing the price action move up very nicely in our preferred our chart of choice, where we take the our trades, but we could actually be trading against the flow, if you like, in a slower time frame. It's perfectly fine. It has all sorts of other implications in terms of risk. It's obviously possibly going to be more risky. You're not going to be in that trade very long, and you have to be very, very tight with your stops. The best way to see it is actually in action. But before we move to the charts, to help with the concept of VPA, what we've done is we've published a companion book to the VPA book, and that is sort of examples, annotated examples. There's over 200 in this one, which accompanies the VPA book, and the examples are taken in this book from stocks, indices, and commodities. There's also a version for the Forex market. So that's what I wanted to say for the benefit of those of you who perhaps are coming along for the first time. Technical analysis based on VPA is obviously only one aspect of what we have to consider as traders. Now, those of you who are already on our Forex trading program will know that it's not just technical analysis that we look at when trying to determine what is what is going on in the market, and certainly with the currency and currency pairs of our choice. We look at the fundamental news, but we also look at what we call the related market, because all the capital markets, of which there are 4, the Forex market, the bond market, the equity market, and the commodities market, they're all related. They all sort of bounce off each other. There are correlations. There are correlations between certain currencies and other instruments in other markets. What happens in one market will perhaps lead what is happening in another. So you have to look at the market in its entirety, not just focus on the one chart that maybe you are looking to take a trade on. And today has been a really good example, because obviously those, if you've been paying attention to your news feeds, you will know, and the And the fundamental news, this has been the event of the day, which is the J. Powell. In fact, the event of the week is what's called the Jackson Hole Symposium. It's a sort of central bank hoolie that happens yearly. This year it's virtual because of the pandemic. And you know, the market has been waiting. J. Powell has kicked it off, but they've also been waiting to see whether he was going to make any an announcement, a statement about how the Fed, and really when the Fed speaks, he's really speaking for the other central banks as well, about inflation. Those of you on our program will understand, you know, this in greater detail. And if you don't, you know, if you're not aware of why you have to track inflation, not just from a personal basis, but why the market and the central banks are obsessed with it at the moment, it's really important that you begin to understand, because it will impact what is happening across the markets. Whatever you trade, whatever the central banks are doing at the moment, it's going to have an impact, not just in the forex market to do with the currencies, but also in the equity market, the bond market, and then spill over into the commodity market as well. And essentially, in case you don't know, central banks have set themselves what they call this 2% target for inflation. And it's just an arbitrary number that they sort of plucked in there. It could have been 2.4, it could have been 1.8. But no, 2% is the figure that they would like inflation to run at. It's a bit like Goldilocks. Central banks like their economies to be like Goldilocks, not too hot, not too cold. Unfortunately, they don't seem to be able to produce that effect, either because events, as we've seen with the virus, or they allow things to get completely out of hand, as we saw in 2000 when, you know, the Nasdaq sort of soared, and then there was, you know, there was a huge bust, as it were. But essentially, this 2%. Is this, you know, this figure, if you like. Now, what he has basically said is that they're going to be more flexible in this 2%. And what he's actually saying is that they are going to be prepared to maybe let it run higher than 2%. That has all sorts of implications, because back in the day, when certainly David and I were much younger, inflation was, you know, the one thing that it had to be kept as low as possible, because it destroys savings, you know, things become very, very expensive, etc., etc. But banks now are actively trying to drive inflation into the market, and they are doing that by printing lots and lots of money, if you like, because the more money you have that's circulating around, then, you know, inflation goes up. We end up, you know, you could end up somewhere like Zimbabwe, the value of money decreases. So he opened the symposium, he has said this. What has been the market reaction? Well, it's been a bit sort of all over the place, really. There was the usual volatility. Well, usually have the volatility at the beginning of the market open. If we take the YM, because the YM is a good example of one of the indices. Initially, it went up, then it went down, and now it's kind of trying to creep up higher. Then it went into consolidation, and in fact, it's now taken a little bit of a dive, as it were. The VIX is going up. The dollar went down. First it went up, then it went down. So, and gold, which has always been if you like, the one, if you like, market, the one instrument where, you know, people have been rushing into gold on the fear of inflation and what the Fed is going to do. They want to drive inflation into the economy beyond, not just at 2%, but beyond 2%. In fact, gold actually fell, as we can see here. This is the 10-minute chart, and you think, well, why did that happen? The Fed, you have to kind of think of it in a slightly counterintuitive way. In a way, the Fed, having said that they're becoming more flexible on this 2% target that is just now an average, it kind of tells people, well, maybe they're not going to succeed. You know, inflation is driving inflation higher is actually going to be a problem. It's certainly been a problem in Japan for the last 20 years or so. They've had no matter how much QE they seem to indulge in, inflation is still very, very low. So that could be the reaction from the gold market. Now, there is also another instrument for those of you who want to know a little bit about this, and this is called the TIP. The TIPs are Treasury Inflation Protection Securities. They're like a form of bond, and people buy them. People buy them when they think inflation is going to be out of control, because it protects you against the effects of inflation. And this is an ETF, and ETFs are a great way to try and get a feel for what market sentiment is, what different parts that, you're not having to invest in them unless you particularly want to, but it gives you an insight into what the market is thinking. And the TIP certainly is an ETF which is, and if you are trading gold, I would probably suggest you keep an eye on this as well, because they kind of correlate with one another. So if the TIP is rising, they think inflation is going to be rising, gold will tend to be rising. But this is on the daily chart. It's been a little bit, it's gone into sideways, as it were, pretty much reflecting what gold has been doing. It went up, as with gold. It's had a bit of a pullback, and now it's moving sideways. So it's kind of reflecting this this uncertainty that the market has, that no one's really sure what the central banks are, whether what the central banks are doing is going to succeed or not. And obviously, if that falls, then the assumption is that there isn't going to be any inflation. Now, gold may still rise, because gold also rises, not just because of inflation, because the whole financial system has been completely, I wouldn't say destroyed, but it's there's no value left in money, because that's what we're talking, in paper, if you like, whether that's money or bonds, if you like. So it's you could argue it both ways, as it were. So that's where we are at the moment, in reaction to what has been going on with the beginning of Jackson Hole. I think the Canadian governor has just been speaking. His name's Markham. He's a new guy, so you have to sort of keep, wherever you are in the world, if you're in Canada and you're a trader and you're an investor, you really need to know who your central bank is, and get to know the personalities. It's one of the things we say on our program that our traders must do. So, and particularly if you're going to trade a currency, the Canadian dollar is one of your preferred, or here in the UK we have obviously the British pound. It's really important that you get to know who your central bank is, who are the members of the central bank, who carry weight on the committees, because certainly with the Fed, obviously the chair does, and the vice chair, but on the Fed committee, some members don't vote. They don't have the voting rights. They kind of rotate them. So when one of the Fed's people pop up in the media, if they are a voting member, then their words are going to carry more weight, if you like, in the market. But if they're a non-voting member, yeah, people will say, well, that's awfully interesting, but he or she's not going to have much of an impact at the next meeting because they don't have a vote. So it's really, really important that you understand what the central bank is up to, what is the monetary policy of the central bank, no matter what you trade, whether it's equities, commodities, and certainly with the a currency market, then you really, really must know. So that's where we are at the moment. With the YM, David has got the faster time frame chart. So the other question we always get asked is, well, what do you do when you have this kind of price action? Obviously, this is the market reaction and knee-jerk reaction to whatever, an announcement, a piece of news. It could be anything. You get these huge candles. We do have an indicator that we've developed called the volatility indicator, which fires in real time, which tells us that volatility has come into the market and the price is now outside of its average true range. What can we expect? The expectation is that the price will usually retrace to within the spread of the candle. We normally get a congestion. in this case, another one was fired up, and then a third one. This is as the not only did it coincide with the open coincided with Powell's speech, then you had one to the downside, as we saw here. We had a retrace in, but essentially what happens when there's shaking of the market, it starts to calm. The next stage is actually a congestion phase. The market will go sideways because everything has to calm down, and we have to wait and see, you know, what is the eventual direction. And in fact, with the YM, it as you see here, after this after the volatility, it did actually go sideways. Whether there were trading opportunities, this is a 10-minute chart, whether there were trading opportunities in these big candles in the congestion phase, there might have been, because you as a trader, you might be trading on the second chart, a tick chart, a Renko chart, 1 or 2 minute chart. There would have been a potential trade to be taken. If you're on the slightly slower time frames, as I am here on the 10-minute, then you would certainly want to wait for a very firm pull away from this volume point of control. It's the area on the chart, it's the fulcrum of the chart. There's no real direction in this particular time frame. And there was a really nice example of this with a cable, and as I said, but it could have been anything. What I have here, I have a 3-minute chart, a 5-minute chart, I have a Renko chart for cable, and I also have a chart on the 10-minute for cable with levels. Now, when I said earlier, the one thing that is also critical at times of volatility is to have some way of marking on your chart key support and resistance levels. We've developed very specific indicators for this function because support and resistance is such a huge part of VPA price action volume, but support and resistance is like, you know, right up there with it, because even when price is very volatile, it will still respect those levels. It may overshoot them slightly, but it will generally respect these key levels. And this is, if you like, the equivalent of what happened on the 10-minute chart with a cable reflecting what was going on with the US dollar. As I said, it went down, then it went back up. Very dramatic. You can see the huge widths to these candles. But look, it kind of hit what, this is the R4. This is based on Camarilla, but you know, you might use a moving average, you might use a Fibonacci level. It really doesn't matter. But somewhere on one of your charts, you have to have some kind of indicator which tells you this is an important level for the market. And in fact, after this, the volatility, this too went into a congestion between, as we can see here, the S1, and it actually just fell. It never made the S4 at the bottom of the chart. It sort of hung around the R3. And in fact, the little piece of price action that I was looking at is once that comes, that always, markets don't stay in congestion forever. They eventually do have to find a direction. In fact, there's this really nice little move. It wasn't very big. It was a nice little move, but it went straight into, again, this is where the levels came into play once again. And in fact, there's been a little reversal, and it's now going between the R1 and the S1. But given the time of day, it's probably not unreasonable to expect that it will go back into congestion. And to help us, particularly when markets are so volatile, is to move to combine your time chart with a non-time based chart. We've developed, David and I use a Renko. Sometimes David also uses his tick charts as well. But the Renko chart, it smooths everything, so you don't get any wicks to the bricks. That's what they are. They're not candles. They're called, Renko means brick. That's the first thing. And secondly, the value of these bricks, that's been calculated for me by our Renko optimizer, which is now, these are set at 2.9. So every time 2.9 pips goes through the market, one of these little bricks is completed, as it were. On this chart, I also have one of our other indicators, which is what we call the accumulation and distribution indicator. And it basically measures the strength of support and resistance. So the thicker the lines, the stronger, if you like, either the support or the resistance. And this was this little move higher. It was off the S3, ran straight up here, a little bit of sideways. And how we use this in how we use the Renko, or how we've combined it with our other indicators, is we have developed trend indicators, the trend dot, which is this, as you can see, this is very, very close to the market, and we have the trend monitor. And it's a very straightforward way of using the indicator. First of all, you look at the structure of the price action on the chart, and it's very clear what was going on here. We can see the congestion. This was after all the volatility. You know, there was no firm, they would try to break away from these regions, and it kept pulling back again. And what happens, how that's reflected, it's reflected in these constant changes in not only the trend dot, but the trend monitor. But once you have, if you like, a break from a significant level, be it based on price or volume or a combination of the two, and you start to get these you know, the trend dots consistently blue, and this is a consistently bright blue, you could say, do you know what, that's probably, you know, that looks like a half decent break. And you would also compare it with the time chart to see whether the volume is also supporting the candles on the chart. And in this occasion, it did. And also, it's, you know, you can see it's moved away from this strong region of resistance. And the nice thing about breakaway trading, I always think, is where your stop loss is, because these levels here, they're there for your stop loss. So in a way, in a breakout trading and a breakaway trading, if you have this information on your chart, you know where your stop is likely to be. If you want to make it tight, you could have put it down here under the S2. If you want to make it even tighter, you could have even put it very, very close to this support line here, and you literally just let it run. With the Renko, you let it run. Eventually, as always, when a trend is coming to a pause point, what happens is it will go into a congestion. I know we get, you know, dramatic V-shaped reversals, and what is that? The opposite of the V-shape at the top. But generally speaking, with price action, it will go into a congestion and then perhaps break to the other side. And this is what happens with price action on all time frames. So that was cable. And of course, the final thing with having levels is they also give you an objective, a price target, a price objective. Where is this price action likely to stop or pause? That's what levels do. That's what the levels are there for. They're not just to help you with having an understanding of the price structure on the chart, but they're also there to help you with your stop loss, but also to help you, well, you know, where is this going to? And once you get to one level on, this is the 3-minute chart, and perhaps it goes through, you say, well, where's it going next? You move up to the next time frame. I've got the 5-minute chart here. If this had gone higher, well, where was the next logical stopping point? Well, possibly this zone here. This is part of the volume point of control. Ultimately, if it did go higher, it would go to the high at 132.80. But if you combine that with the levels that we see on that derive from the Camarilla, we've actually got 32.70, which is the R4. The fourth level on the Camarilla is actually a very important level. So even though you've had volatility, even though you've had you know, markets not really knowing how to react to, you know, what Jay Powell has said, and it's perfectly, you know, markets aren't logical at the best of time. They're all driven by emotion. Once everything calms down, you can take you know, you step back, you take a cool look at what the chart is telling you, and you trade what you see on the chart. And as I said, I think the cable is a really nice example of that.